to the webinar. So this is the 11th time for us to conduct the webinar series. So we have around 170,000 audience following our last 10 live stream webinar. And last week, we had pleasure to invite Mr. Ram Seshadri, the machine learning expert from Google, and we were discussing on artificial intelligence, which is shaping a new economy powered by big data and advanced analytics. So many financial firms have started to integrate artificial intelligence into their operation, and more importantly, big tech companies such as Amazon and financial seems to take more advantage on that. But we must also understand how to identify and manage the associated risk while we enjoy the benefit arising from that. So the COVID-19 crisis has accelerated this trend. Temporary closure of shops and restaurants, or the desire to socially isolated led people to increasingly turn to online shopping and the digital payment. So I think it is timely to have discussion on FinTech and the big tech credit market around the world. So many thanks for Dr. Jon Frost bring that interesting and valuable research with us. So in my short remark today, I would like to touch on an issue, the impact of the increasing use of technology, big data, and artificial intelligence by big tech firms. So on the one hand side, big tech firm provides those unbanked or underbanked group by expanding the scope of credit assessment. For example, the social network activities, and also the platform sales record. So previously, those underserved group can access finance successfully. So it improves and increases the financial inclusion. So on the other hand side, we must also have awareness that problem in this space can be difficult to detect, as the data set and the algorithm used are often proprietary and private. So some have concluded that a system built on big data and sophisticated algorithms are objective and make it harder to discriminate people. But I believe the truth is that if this system rely on data that reflect the historical data deeply embedded in our society, the system themselves may discriminate somehow, so which is biased in and biased out. So we hope that today's webinar will go further than simply celebrating the success, the momentum, the future promise of FinTech, but also how do we leverage technology and tackle the difficult questions that are arising from that. So I believe today's webinar is unique situated to have such discussion, given we have both keynote speaker from Bank of International Settlement and also another 3 specialists from People's Bank of China and the university professor to join us as panelists. So with that, I want to turn to our distinguished guests. We have pleasure to invite Dr. Jon Frost, Senior Economics Innovation and the Digital Economic at Bank of International Settlement. Jon is also research affiliate at Cambridge Center for Alternative Finance at the University of Cambridge. Previously, Jon worked at the Financial Stability Board, Netherlands Bank, VU University in Amsterdam, and in the private sector in Germany as well. So his work is focusing on policy-oriented research on FinTech and digital innovation. Next to Jon, we have Mr. Mu Changchun, the Director General, the Institute of Digital Currency at People's Bank of China. Previously, Changchun is also Deputy Director of the PBOC's Payment Department. He is also leading the team with many excited initiatives on digital transformation for finance. So we are very excited for hearing from Changchun Mo during our discussion. So next to Changchun, we have Dr. Zhang Zhenyun, Assistant Professor at the College of Law at Zhengzhi University. He is also the director of the FinTech Regulatory Innovation Laboratory at FinTech Research Center of Zhengzhi University. Previously, he served as a research fellow with UNSW Law and was a member of UNSW Law's Digital Financial Service Research Team. So his research is focusing on FinTech, RegTech, cryptocurrency, blockchain, regulatory sandbox, and open banking in particular. So next to Zhenyun, we have Paoyi Janvinano, lecturer in law at Thammasat University, one of the most distinguished universities in Thailand. He is also research affiliate of Cambridge Center for Alternative Finance at Judge Business School, University of Cambridge. He is also the co-author of ASEAN FinTech Ecosystem Report published by CCAF at the University of Cambridge. So we will start from Jon to have his keynote speech, followed by a discussion joined by Changchun, Zhenyun, Paoyi, and myself. So Jon, the floor is yours. Thank you.
Thank you so much, Hong Yi. Thanks for the kind invitation, and thank you as well to Changchun, to Paoyi, and to Cheng Yun for agreeing to serve as discussants. It's a great honor to present here today. What I'm going to discuss, as Hong Yi has alluded to, is a transformation in credit markets around the world. So while banks, credit unions, and other traditional lenders remain the chief source of finance for companies and households in most economies, new intermediaries have recently emerged, offering fintech and big tech credit. At the BIS, we've done quite a bit of work on fintech and big tech credit in the past couple of years. For instance, Stein Claessens, Feng Zhu, Grant Turner, and I did a piece on fintech credit markets around the world for the September 2018 BIS Quarterly Review. Hyun Song Shin, Leonardo Gambacorta, Yi Wang, Pablo Binden, and I have a working paper on big tech and the changing structure of financial intermediation from April 2019. And this is now forthcoming in the journal Economic Policy. Finally, and perhaps most importantly, the BIS put out a special chapter on big tech and finance, opportunities and risks, as part of its annual economic report last year in June 2019. And we've made links to all of these papers available to participants. They're also included in the slides that I'll be using. So Hong Yi, we can go to the next slide. Today, I'll be giving insights from new research. This is joint work with Giulio Cornelli, Leonardo Gambacorta at the BIS, and Raghu Rao, Bob Wardrop, and Tanya Ziegler at the Cambridge Center for Alternative Finance. It's forthcoming as a BIS and CCAF working paper. We'll also make available our data set on fintech and big tech credit volumes by country. We hope that this will be a valuable resource to researchers, students, policymakers, and practitioners working in this area. So in my presentation today, I'll start with some groundwork on fintech and big tech credit and some selected trends in these markets. I'll discuss our research question and contribution. I'll talk briefly about the related literature on this topic. It's a growing body of literature before going into our data construction and empirical methodology. I have a couple of slides on our results on fintech and big tech credit and country institutional factors. Finally, I'll conclude with some thoughts on the financial stability implications of these forms of credit and the impact of the COVID-19 pandemic. Here we go. So what are fintech and big tech credit? Well, both of them are forms of fintech innovation. Here on the left, you'll see the definition of fintech used by the Financial Stability Board, or FSB. Fintech is technology-enabled innovation in financial services that could result in new business models, applications, processes, or products. I think everyone is well aware of what fintech looks like in practice. Think of all the new mobile payment innovations that have emerged in recent years, but also new applications for wealth management and insurance. Meanwhile, this is the second column, FinTech credit is credit activity facilitated by online electronic platforms that are not operated by commercial banks. This includes peer-to-peer or P2P lending, so-called marketplace lending, and also other forms of credit like invoice trading. There are some well-known examples of these platforms in countries around the world, which are shown here on the bottom. For instance, Zopa and Funding Circle in the United Kingdom, Lending Club and SoFi in the United States, and a number in China, Yiren Digital, Lufax, and many others. Also Mintos in the European Union, Harmoney and others in Australia and New Zealand. Finally, the third column, Big Tech, refers to large companies whose primary activity is digital services rather than financial services. So this distinction is important. Tech companies with large networks and a broad range of activities also have access to data on their users that they can use in financial services, including credit. So in China, people are of course very familiar with Alibaba's Ant Financial, with Tencent's WeBank, with Baidu's Du Xiaoman, and the financial services offerings of JD.com. You may also be familiar with the big international tech players like Amazon in the United States, in many countries, Rakuten and others in Japan, Kakao Bank and K-Bank in Korea, Grab and Gojek in Southeast Asia, M-Pesa, Airtel, and MTN in Africa, and Mercado Libre in Latin America. These are just a few examples. These companies have large non-financial businesses, and in the last years, they've begun offering credit either directly or in partnership with financial institutions. So in the paper, we've assembled estimates of the size of lending by big tech firms with the help of contacts at central banks and big techs and public information. And we put this together with data on FinTech credit from the annual online survey of the Cambridge Center for Alternative Finance. So based on these data, we see that big tech credit in particular is booming. That's represented by the blue bars in the chart on the left. We estimate that big tech lending flows reached $572 billion in 2019. FinTech credit, which is represented here by the red bars, was about $223 billion in 2019. FinTech credit flows have actually declined in the past couple of years, driven entirely by the developments in China. In other countries, FinTech credit is actually still growing. I'll get back to that in a moment. Now, if you look beyond China, and we can go to the next slide, you can see that FinTech credit is growing in some cases quite rapidly. For instance, in the Netherlands, Germany, France, and Italy, also in Australia, Brazil, Indonesia, Japan, and Korea, FinTech credit volumes may have passed $1 billion per year in 2019, based on our preliminary estimates. But for big tech credit, the largest market by far is China. There are a substantial number of big tech firms offering credit in China, in some cases very large volumes, both directly and with financial institutions. And there are also large big tech lending volumes in Japan, Korea, the United States, and a number of emerging market and developing economies, including in Asia. In some places, like Kenya, these activities are becoming quite economically relevant. Let's go to the next slide. So FinTech credit in China is a bit of a unique case. There were many platform entries in 2014 to 2016 and a favorable regulatory environment. But since 2018, there have been new regulatory measures and a lot of platform exits. And I think we may hear about this a little bit more later. As such, we see that both the stock and the flow of FinTech loans is declining. And of the remaining loans, we see that they have a longer average loan term. Let's go to the next slide. So as mentioned, there are important differences between FinTech and big tech credit. One of them is around profitability. FinTech credit platforms make money with fees, intermediating between borrowers and investors. The return that they offer investors is based on the interest rate that they charge to borrowers, minus the net losses and their fees. We see that those returns to investors were quite high several years ago, for instance, again in 2014 to 2016, but they've declined over time as net losses have started to tick up. We don't yet have data on how these loans have performed during the COVID-19 pandemic, but we hope to have that soon. If we look at the profits of the platforms themselves, shown on the right panel, we can see that FinTech credit platforms have often had negative profit margins. as platforms have invested their proceeds to achieve growth. It's only in 2019 that our selection of fintech credit platforms actually posted a positive net profit consistently. Big tech firms, by contrast, are often very profitable because of the high margins in their core business lines, like advertising, social media, e-commerce, and ride-hailing. These resources give them a competitive advantage that may help them to grow rapidly, particularly when they partner with regulated financial institutions. So I'll now talk about the research question in our paper and our contribution. We can go to the next slide. We're interested in knowing the following things. First, how large fintech and big tech credit markets are in absolute terms and relative to overall credit markets. Second, what economic and institutional factors are driving their growth and adoption. And third, how large and important they could become in the future. To answer our questions, we construct a new database of fintech and big tech credit volumes for 79 countries around the world over 2013 to 2019. We give insights into economic and institutional drivers of fintech and big tech credit based on cross-country panel regressions. And finally, we provide an empirical grounding for the discussions of future growth of fintech and big tech credit and its policy implications. We can go to the next slide. Our study fits into a broader literature that emphasizes the importance of credit in the economy and the importance of good statistics on credit markets. So as we know, credit contributes to economic growth and welfare, yet rapid credit growth can also be a harbinger of financial crises and severe recessions. So there have been ongoing efforts to improve the data on non-bank credit to the private sector and also on fintech credit. Still, data on fintech credit are scarce. Really, the survey of the Cambridge Center for Alternative Finance is the best source of data that we know that's comparable across countries. And the data on big tech credit are even more scarce. And there is some irony in this, given how central data is to the credit decisions and to the whole process of offering big tech credit. Still, the data on the scale of these activities is very scant. So for big tech in particular, there are a number of relevant policy issues that Hong-Yi mentioned at the beginning. These are things like price discrimination, issues for competition and data privacy. But monitoring these markets is not possible without aggregate data. Like good airplane pilots, central banks and regulators want to have a good overview of where they're flying. They don't want to be flying blind. Let's go to the next slide. So what are the factors that we expect to explain? More developed markets have firms and consumers who demand more credit. It should also be higher where that demand is not met. So Harold Hao, Yiping Wang, and others have a great study on this in China. Deroor and others show something similar for Germany. And Tang and Jiangtian and Lemieux show these results for the US, that where there's unmet customer demand, where traditional banks are not serving a certain segment, there you have higher fintech and big tech credit. Finally, we expect that a lack of competition in the incumbent banking sector is associated with higher fintech and big tech credit. So we can also think about supply side drivers. Here, a key driver is access to big data by fintech and big tech lenders. This is a key input into their business model. They may also have a technological advantage in processing these data, thanks to artificial intelligence and machine learning algorithms. Of course, the regulatory stance likely plays an important role as well. Finally, there's a broad range of institutional characteristics that should matter, such as the ease of doing business, disclosure rules, investor protection, and the development of financial markets. Let's go to the next slide. So as mentioned previously, we use data on fintech credit from the Cambridge Center for Alternative Finance, and specifically from the Global Alternative Finance Database. The category loan-based alternative finance in the CCAF database is equivalent to fintech credit. The data are available for 2013 to 2018. In order to arrive at 2019 estimates, we've used other sources such as Brismo, WDZJ, the Korean P2P Lending Association, and central banks' input. For big tech credit, we hand collected data from public sources, company contacts, and central banks. A big thanks to everyone who contributed in that regard. We did this, in some cases it was necessary to convert from lending stocks to lending flows and vice versa. We did this based on information about the average loan term, assuming that a certain proportion of loans mature each year. So lending flows are simply the difference between end-year stocks plus the value of loans that matured over that year. For big tech, the 2019 numbers were in some cases extrapolated based on user numbers, revenues, and other sources. In some cases, we also had to make assumptions about how we distributed volumes across different markets in which a firm operates. We calculated all of this at the firm level, but for confidentiality reasons, only the aggregate country level volumes are made available, and that's what we'll use in our analysis. Let's go to the next slide. So to analyze the drivers of fintech and big tech credit, we use the following empirical methodology. We estimate the natural logarithm of fintech, big tech, and total alternative credit per capita in economy I and year T, that's credit IT on the left, based on the following variables. First, GDP per capita, which is a measure of economic development. We also use its quadratic term, so GDP per capita squared, in case of a nonlinear relationship. Second, we use the learner index of banking sector markups. Where markups are higher, there may be higher margins and hence less competition in banking. Third, we use the density of the bank branch network relative to the population. Where there are fewer bank branches, there may be more unmet demand. Fourth, we use regulatory stringency for the banking sector based on a World Bank survey. Where this is higher, banking regulation is more strict. Fifth, we use a number of control variables, including annual GDP growth and total credit growth, mobile phone subscriptions relative to the adult population, a dummy for countries that had a financial crisis since 2006, and a dummy for advanced economies. Sixth, we use a vector of geographical area fixed effects, i.e. regions of the world, and finally, the standard error term. We estimate this using ordinary least squares, with standard errors clustered at the country level. Next slide. So let me show you our results. So estimations for total alternative credit, which is the sum of fintech and big tech credit, are shown in the first column on the left. Big tech credit is then shown in the second column, marked with A, and fintech credit in the third column, marked with B. The final column gives the difference between the two, B minus A. So if we look at the table, a few things pop out. First, it seems that both fintech and big tech credit increase with a higher level of GDP per capita, but as you can see from the quadratic term, at a declining rate. This effect is larger for fintech credit. Second, both fintech and big tech credit are higher where there are higher banking sector markups as measured by the learner index. Once again, this matters more for fintech credit. Third, the density of the bank branch network is negatively correlated with the development of fintech credit, but not big tech credit. The difference between the two coefficients is statistically significant. This is consistent with the view that fintech credit serves clients in underbanked areas, and therefore the credit supply is complementary to traditional bank credit. Big tech firms, while also relying on digital distribution channels rather than physical branches, does not appear to be more common in countries with few bank branches, all else equal. Fourth, the coefficient of the stringency of banking regulation is negative for both forms of credit. So this means that more stringent or more strict banking regulation is significantly linked to less big tech and fintech credit activity. So banking regulation explains about 10% of the variability of total alternative credit per capita in the baseline model, and about 1/5 of the R squared. So it's a relatively important variable. And this could suggest that regulation of alternative forms of credit in general is more liberal in jurisdictions where banking regulation is more liberal. In any case, this result is not consistent with regulatory arbitrage being a key driver of fintech and big tech credit, at least not in aggregate across the countries we're considering. Again, we find the link to be much stronger for fintech than for big tech credit. Let's go to the next slide. So we've also looked at a broad range of country-specific institutional factors. In the interest of time, I won't show the regression tables. We do have them in the annex. I'll just quickly summarize instead. So there are a few results here that are interesting, and in these cases, because these variables are relatively correlated with one another, we've looked at them kind of one set of variables at a time, and I'll just indicate with stars and the negative sign, whether there's a positive or negative link, and how statistically significant it is. So first, we find that total alternative credit is positively correlated with all the indicators that measure the ease to start a new business. So in countries where the ease of doing business is higher, there's more FinTech and Big Tech credit. Second, we find that countries with more disclosure and stronger judicial systems have more developed FinTech and Big Tech credit. So this is consistent with these countries being relatively easier to operate in, having higher investor protection, which may be attractive for the FinTech and Big Tech lenders. So this would likely be a supply side factor. Third, we find strong links with a number of banking sector characteristics, including the credit to deposit ratio, regulatory capital to risk-weighted assets, provisions to non-performing loans, loans from non-resident banks, and firms with a transaction account. So overall, this underscores that FinTech and Big Tech credit may complement bank credit to firms. FinTech and Big Tech credit are higher in those economies where banks have adequate capital, where they have strong provisions and a strong deposit base, and where firms have access to banking services. But this link with foreign non-resident banks is interesting because that may actually indicate a lack of competition. Where there are fewer non-resident banks, there may be less bank sector competition. That would again be consistent with what we showed for the Lerner index of banking sector markups. Fourth, we find a strong correlation with various measures of financial market development. This again underlines the complementarity of FinTech and Big Tech credit with other forms of finance. So let's go to the next slide, and let me now conclude. So overall, we've shown that FinTech and Big Tech credit are growing fast to an estimated level of $223 billion for FinTech credit and $572 billion for Big Tech credit in 2019. Both forms of credit are higher, first, where there's higher GDP per capita, but at a declining rate. Second, where banking sector markups are higher. And third, where banking sector regulation is less stringent. Moreover, FinTech credit is more prevalent where there are fewer bank branches per capita. We also showed that total alternative credit is higher where the ease of doing business is higher, with greater investor protection and judicial system quality, where bank capital provisions and deposit funding are higher, and where financial markets are more developed. Overall, our findings suggest that alternative forms of credit seem to complement more traditional credit markets, not to substitute for them. Let's go to the next slide. I promised that I would conclude also with some thoughts on the current context and on financial stability. So let me quickly do that. So the really interesting question is what will happen over 2020? We've been showing volumes for 2013 to 2019, but what will happen this year given the COVID-19 pandemic and other developments? So the COVID-19 pandemic has likely had a big impact on both FinTech and Big Tech credit. Big Tech firms have seen surging demand for their core business lines. Both FinTech and Big Tech credit platforms have in some cases been involved in the distribution of government relief to companies, for example, in loans to small businesses. It's an open question how these firms will fare, but we do expect to see Big Tech credit perhaps continue to grow in the coming years. There are important questions about the implications of FinTech and Big Tech credit for financial stability. So where new types of credit grow very fast, we know from the past there's always the potential for a credit bubble. Will that happen here too? We don't know yet, but certainly the high growth rates of FinTech and Big Tech credit in some markets and the fact that they are becoming economically relevant in some specific market segments could be flags for regulators and central banks to monitor this carefully and to consider these financial stability implications. So this is uncertain, certainly, but one thing is certain. Central banks and regulators shouldn't be flying blind. As such, we argue that efforts to bring FinTech and Big Tech lenders into the fold of official regulatory reporting should continue apace. Thank you very much. I'd like to now turn to the discussants. And of course, happy to respond then to questions. Thank you.
Okay, thank you very much, Jon, for your really impressive keynote speech. And I think that you really bring those very insightful data set with the rigorous academic research methodology. So many thanks for that. And I think it is really timely to have such discussion, given, as you know, just 2 weeks ago, that Ant Financial just changed their name to Ant Technology. So whether that is the technology driven or the financial driven, and how do we envisage the FinTech or the Big Tech in the next 5-10 years, that will be very interesting. So with that, I want to turn to our discussion. And first, I want to get the perspective from Mr. Mu Changchun from People's Bank of China. Mr. Mu, are you there?
Hello.
Hello, Mr. Mu. This is Hong Yi. I'm from Zhejiang University. Many thanks for your valuable time. And I think, as Jon briefly mentioned, I think it's very interesting to see that how FinTech and the Big Tech now their role is getting more important. And particularly, we just had a discussion that 2 weeks ago that Ant Financial just changed their name to make the announcement to be Ant Technology. So I think, given that you are working for the central bank in China, I think it will be very interesting to get your perspective and any feedback for Jon. Thank you very much.
Sorry, it seems I cannot actually access from my computer. So now I can only access from my mobile. It seems that the Zoom already banned all the new users from China. It was a very new change today. Of course, firstly, I think Jon's the report is very good and excellent report, and covers a lot, and already get a very meaningful and trustworthy conclusion, and also it's very detailed. There are very convinced evidence of this data. And firstly, I think I would like to share some information of China. Actually, I think that's the categories by this report is very informative and very innovative. That is to classify it into FinTech lending and Big Tech lending and other categories. That these categories of classifications are very, very good, I think. And firstly, I think the FinTech lending, which we call it P2P lending in China, actually is a very, very wild sector. Since 2007, the FinTech lending providers, the service providers, almost reached 6,000 companies, FinTech lenders in China. That is very, very wild growth back to 2007. And after the management and the regulation, by June of 2018, that the number decreased dramatically, and down to 1,400, and of course it's decreasing continuously, and by the end of August of 2018, there are only the normal. I mean, the stable. The situation already became very stable. So the FinTech lending actually is had a soft landing in China. So that is the situation for the FinTech lending in China. For the Big Tech lending, I think everybody knows that we call the Alipay, the Ant Financial, and WeChat. These two financial group, they are providing Big Tech lending to the general public. And for my personal view, there are some, regulatory difference, or we can call it a regulatory arbitrage between the big tech lending and normal commercial bank lending. I can describe some of the differences. Firstly, from the regulators' side, from the regulator perspective, actually the credit cards and commercial bank lending business of the commercial banks are regulated by the CBIRC, which is the CBIRC, and also part of their business actually are regulated by the People's Bank of China. But both Alipay, we call it Huabei, actually they are regulated by the local government because they are micro finance companies, so they are regulated by the local government. But because of the lending approach actually is an online approach, so actually although it's a micro finance company registered with a local government, but actually their business already covered the whole country, the whole territory. So it is already beyond the supervision of the local government. And from the perspective of the business rules and the access of the users, for the normal commercial bank lending business, all the loaners, or the debtors, they have to have a resident, a fixed job and reliable payment methods or payment income resources, especially for the students' loans. They have to be covered or guaranteed by other income sources like their parents or other supervisors. But for the micro financing companies, the big techs, they don't need those requirements. There's no such kind of requirements. For the KYC perspective, all the credit provided by the commercial banks, they have to do the KYC by face-to-face. But as you may know, all the big techs, they have their technology which is called 310. So they need a very fast, approach to satisfy the user's demands, to satisfy the user experience. That will, they have to do the KYC from the remote approach, which is different from the commercial banks. And for the authentication of the transaction instructions perspective, the commercial banks have to authentize all the payment instructions by the loaner or debtor himself or herself. But the big techs don't need those stringent authentication methods or approach, although it's also a very secure one, but different from the traditional commercial banks approach. So those are the differences, or in terms of regulatory or the credit providing approach. So, and having said that, I think I would like to give the audience a story, a historic story that happened back to decades ago in South Korea and Taiwan, China. And in those two areas, it happened. We call it a credit card crisis because we incurred during that time that period, the regulators in South Korea and Taiwan, they encourage young people to consume, to make consumptions beyond their capacity, beyond their repayment capacity, and encouraged to consume as early as before, as much as they can. So that will create a problem as a overconsume or overconsumption culture. So that may have some implication or financial stability implication for the credit online credits or big tech credits or the FinTech credits. So I would like to remind all the audience and the experts that the crisis, this time is not different. We have to be alerted or keep in mind that the crisis may be not far from us if we don't respect the basic rules that we have to consume within our capacity, within the repayment capacity. I think I have said all, and thank you very much. Thank you, John, for the invitation.
Thank you very much, Mr. Mu, for your insightful viewpoint. And I think before we move to the other discussion to get their perspective, I think we also wanted to take this opportunity, given that we know that you are leading the team and to do many excited initiatives, particularly for the digital transformation in finance. So we would very much like to get your perspective, as we know that the digital central bank digital currency now is getting popular, not only in China, but also regionally and globally. So how do you see that will impact for the FinTech or big tech, given some people maybe see that the CBDC as changing the paradigm for FinTech and the big tech? So how would you respond for that? Hello, Mr.
Sorry, I still got some technical problem with my access to the Zoom. It seems the curtain is closing, is shutting down. Right. So, well, for the digital currency, I think we are now we have several pilots running, and in several cities, including Shenzhen, Suzhou, and Qinyuan, and Chengdu. So there are 4 cities and plus 1, which is the Winter Olympics office area in Beijing. Is went smoothly, and we are waiting for the results and for the pilot project. And of course, we call it pilot, but normally now people will understand as a sandbox program, and we are waiting for that sandbox program results, and we'll see whether we'll have the second one or we are going to roll out for the whole country. But we have to wait for the results. As for the questions of the impact on the big tech or FinTech, I think personally, although people may argue that we are actually born to replace those FinTech or big techs, but personally, I don't actually agree with that kind of views, because as you may know, I can give you an example. Like the big techs, actually, they are providing the service as wallets, like during the period of paper money or banking notes and coins. Actually, people are carrying leather wallets to the streets and to go to shopping. And in the period or era of of electronic payment electronic payment services, people actually are carrying mobile phones and will pay with their virtual wallets, which actually are provided by Alipay and WeChat Pay. So they are not the instruments, because the instruments is still the deposits. I mean, the commercial banking deposits or commercial institutions deposits. Those are the instruments. It's not the Alipay or WeChat Pay who act as wallets, not payment instruments. So in the future, if the CBDC or our ECNY will be issued, the wallets will still be the wallets. I mean, the Alipay and WeChat Pay, all those big techs and FinTechs they will still there to act as wallets and providing the payment services. But the instruments, I mean, the contents in those virtual wallets provided by those big techs will be changed to the ECNY or CBDC, or we originally call it DCEP, our digital currency. But from the perspective of big techs and those fintechs, there are no big impacts on their business. I don't think there will be big impacts on those big techs, because also we, as you may know, we actually took a two-tiered approach to issue the CBDC. So all those commercial banks and the incumbent big techs, they are still there, and they are still going to play as wallets. So their business will not be impacted. The only difference will be the content is different. The payment instruments will be changed from commercial bank deposits to CBDC, to the digital currency. But also, at the same time, it will be a market-driven approach. It's not mandatory to, for the people to make payments with the central bank digital currency. That will be a voluntarily approach and a market-driven approach. People can freely choose whether they can still use their deposits, banking deposits instruments to make the payments via WeChat Pay and Alipay, or they can make digital currency payments with WeChat Pay and Alipay, but the instruments will be different. So I don't think there will be differences, and there will be no big impacts for those big techs. Although we are going to provide more functions, which will be improved comparing with the incumbent commercial bank deposit in payment instruments. Thank you very much.
Okay, thank you very much, Mr. Mu. And I think we will come back to you soon. So thank you very much for your sharing insight. And I think we are very lucky to get the first-hand information from you, and also really appreciate for the effort of you and your team making change of this industry. And we are very glad to see this revolution. So I think with that, I want to turn to Zhengyun. Zhengyun, as we know that you are doing a lot of the work on FinTech, as well as RegTech, cryptocurrency. So we would very much like to get your perspective and also the feedback for Jon.
Okay, thank you very much, Hongyi, and thanks a lot to Zhejiang International Business School for hosting this wonderful event. And I benefit greatly from Jon's presentation as well as your paper. That was a wonderful read, and I think your paper raises very important issues, which is we now are facing a booming fintech and big tech credit market, and how do we do with that? So, but before I proceed with my observations, I would like to quickly respond to Changchun about the point he raised about Taiwan's credit card and cash card crisis back in 15 years ago. I think it's fair to say if regulators didn't pay a lot of or sufficient attention to credit expansions, then things like that will happen. But I would like to emphasize that was actually a banks-driven crisis or problem. And so the issue was not a result from FinTech activities or BTech activities. And going back to Jon's presentations, Hongyi, could you please show the audience the very last slide of Jon's presentations, because I would like to add on his wisdom. Yes, I personally, I'm particularly fond of this very slide, and the last point he raised, I think, is really key to all the issues. I mean, in particular from the regulatory perspective. You mentioned about one thing is for certain: efforts to bring FinTech and BTech lenders into the fold of official regulatory reporting should continue as a path. I think that really begs the questions of the capacity of our regulators in collecting timing data about FinTech credit and BTech credit markets. I think this is the most important part, but also the most difficult part. The reason why it's difficult because now we all understand in order to collect data and efficiently monitor the markets, the regulators must have the legal mandate at the very first place before the regulator is allowed to do so or not. So, but we all understand that legal framework and regulatory frameworks vary from countries by countries. So that means you have to, first of all, subject FinTech credit providers and BTech credit providers to the regulatory purview of the existing financial regulatory regimes. Otherwise, the financial regulators won't be able to collect data in a timely manner. So I think that really begs the questions, okay, which government or regulatory authority is capable of doing that in the legal sense and in the practical sense? And if we don't have such a regulator or such a legal mandate, how could we do about that? And this is for the domestic level. If we bring this issue to the global level, then we will face things like regulatory harmonization problems, right? Because we have the different regulators, supervisories, everyone is following different rules. So how do you harmonize those differences when it comes to faster or harmonize the regulatory reporting, when it comes to timely and efficient data collection, or when it comes to real-time monitoring of FinTech and BTech credit activities? I think that's the first point that I would like to make, and I would like to hear about maybe Jon's or other discussants' thoughts about this. And secondly, I think Jon's paper, you raised a very interesting point. That one. So according to the paper, the finding is that more stringent banking regulation is significantly linked to less BTech and FinTech credit activities. However, it seems to me that stronger capital market regulations, by capital market regulations, I was referring to higher disclosure requirements, as well as an efficient and convenient judicial systems, as you mentioned in the paper. So it seems to me a stronger capital market regulations will lead to more developed alternative forms of credit. So I was trying to make sense of these differences, and here comes my personal explanations. I might be wrong, so feel free to correct me. So I think it appears to me that the regulatory framework might well shape the landscape of a jurisdiction's FinTech and big tech credit market. So typically speaking, banking regulation generally applies to those who are engaging in credit intermediation, taking deposits, or lending out the deposits it has been collecting. And the entry level regulation and conduct regulations for commercial banks are generally more stringent than regulations for any other types of financial services providers. So could that be the case where alternative credit providers, meaning big tech credit providers or fintech credit providers, they might craft their business models in a way to avoid the application of banking regulation? If that's the case, then I would be wondering, then how can we safeguard the financial system from stability risk that may arise from alternative credit supply or activities? Do you think the capital market regulations will be sufficient? Because to me, credit market regulations will stand the first in line to manage risks that arise from fintech and big tech credit activities, right? So do you think that would be sufficient? If not, then how do we deal with the financial stability risks that arise from all those new or novel forms of alternative credit activities? So that's the second questions or observations I would like to highlight. And the third one, I think this topic is very important in a way that I think today's big tech credit providers, they profoundly and fundamentally challenge what commercial banks have been doing for decades, or if not 100 years, right? In the past, one of the most important generating methods for commercial banks would be to take deposits and lend the money out, to borrow short and lend long, to carry out credit intermediations. So their core expertise would be to determine their potential borrowers' creditworthiness. So by doing this job well, and they might be able to know which borrower will be like credible and which is not, which one is willing to repay and which doesn't have the capacity to repay. And that's the business model commercial banks have been running for years. But the problem for me is now we've seen the rise of big tech credit providers. And according to your 2019 paper, I was a diligent student. I was trying to read all these new, very important papers in this space. So I've actually read your 2019 paper, and that one was very insightful as well. And according to your paper, it seems that big tech firms generally have an information advantage in credit scoring comparing to a traditional credit bureau, or even comparing with traditional commercial banks. Then that begs the question of, if that's the case, then it appears to me now big tech credit providers are in a better position to serve customers and to make profits from what commercial banks have been doing for years. If that's the case, I'm not too worried about whether big tech credit providers will take over commercial banks' jobs or market shares, but I'm worried about our contemporary or conventional wisdom surrounding banking regulations is for the supervisors to know better about commercial banks' business models and their operational risks. But now do our financial supervisors have the same capacity to have a better understanding of big tech credit providers? If not, then how on earth we can effectively supervise or regulate the risks that may arise from their activities? So I think those 3 points are my personal, you can say, takeaways on your wonderful presentations. And thank you very much once again. I benefited greatly from your presentation. Yeah.
Thank you very much, Dr. Zhang. I think I fully agree with you. I mean, in terms of one of your point, that regulation itself, I think, is not enough in terms of regulators' capacity is very important. As we see that the regulatory sandbox is adopted by many jurisdictions, but not so many jurisdictions run its apparatus so well. Because of the limited capacity of regulators. So I think that is very extremely important. And before we turn back to Jon, I would also like to get the perspective from Paui. I think given that you are doing the research to review the fintech development and regulation across 10 ASEAN countries, so we will also very much like to get your perspective and the feedback from Jon.
Okay, thank you very much. And thank you, Jon, very much for a great presentation. This really broadened my perspective on fintech and big tech credit market in the world. And I think it is very interesting to see the big tech entry into finance has potential to spark rapid change in the industry due to their customer base and their size. And also, I think as you demonstrate in your presentation that big tech is even overtaking fintech in the past several years. For me, I'm also personally interested in the differences in terms of the development of big tech and fintech credit market in different countries, as it also can reflect the differences in local factors such as income level, and financial market structure, and other potential drivers such as the institutional characteristic of each country. I think this point is very helpful for other countries, especially for developing economy, to capture the idea when it comes to the policy designation. To this, I would elaborate a bit on the information with regard to the use of fintech and big tech credit in Southeast Asia, especially the use of fintech credit aimed at promoting financial inclusion in ASEAN countries, as financial inclusion is a significant issue here, and the level of financial inclusion remains low in a number of countries in ASEAN. Given that scoring credit list for Southeast Asian SME has been a challenging task due to the lack of credit history with the financial institutions and banks. That is also the reason why that supervisory agency in a number of countries in ASEAN, we also started to use digital finance, including fintech credit as well, aimed at promoting financial inclusion. However, to support fintech and big tech credit, ASEAN countries, we still need regulations, not only regulations for new type of financial intermediation, but also regulation concerning a personal credit information, such as the Credit Bureau Act of each country, may need to be amended. This is also to include more and more fintech and big tech firms to be members of the National Credit Bureau, and to let National Credit Bureau can get more comprehensive credit information, and also allow fintech and big tech firms to handle alternative data. And I think this is also corresponding with what I work for the Thai National Credit Bureau before as well. Apart from the regulation, I would supplement that a number of countries in Southeast Asia, we are also trying to develop digital infrastructure in our country. The launch of eKYC initiatives in a number of countries also can be reflect our attempt to create a robust digital ecosystem, which is also necessary for credit activity facilitated by online platforms such as P2P lenders as well. Also, there are a number of initiatives launched recently to expand the credit information sharing activities in ASEAN countries. Lastly, I think I would address here that even we can see so many initiatives and projects launched by government in Southeast Asia, but it is also need to say that it is still challenging for us especially for developing economies to find the best regulatory practice and to find the best supervisory mechanism due to many reasons, such as the lack of regulations, as I mentioned earlier, and also the lack of resources, and also the lack of person with technology skill. Yeah.
Okay, thank you very much, Pao-Yi. So I think, Joe, we got plenty of questions and feedback. So I think it is very excited to know how you would like to respond for that.
Yeah, thank you very much. I really appreciate the comments from Changchun, from Cheng Yun, and from Pao-Yi. So thank you. I'll just very briefly address a few of the points in turn. So starting with Changchun, then Cheng Yun, and then Pao-Yi. So Changchun mentioned that there are different requirements, regulatory requirements for big tech credit relative to incumbent banks. And this is a very important point and comes back to something that I'll get to later, which is that even though at the aggregate level we find this negative link between total alternative credit, so fintech and big tech credit, and banking sector stringency, there may be specific cases where regulatory arbitrage does play a role. And I think that it is, in this light, very important to consider those cases and also to look for evidence on this. But I think that the Chinese example is very interesting, and it's something that Changchun and I have discussed and that I'm we're very interested in following up on. I fully agree with him as well. You mentioned this time is not different. Think of the credit card crises in the past. And it's certainly true where there is rapid credit growth and where there are regulatory gaps. Very often this is something that does go sour. And I think that in that light, if we want a sustainable growth of this sector, if we want growth that's not just very fast in the short term, but that can be sustained over the long term, such that these forms of credit can play a productive role in the economy, it's very important that regulation is adequately tailored and that it addresses the same risks that we've been worried about in bank credit and other forms of non-bank credit in the past. On DCEP, that's I think Changchun's input was very valuable there as well on the Chinese CBDC initiative, which we're all following with a lot of interest as well. And the point that fintech and big tech wallet providers will have a role in this system too, I think is very important. CBDCs could be a new public infrastructure that allows different providers to offer services on top of a public infrastructure, so to compete on a level playing field. And this, of course, may well be superior to the kind of closed walled gardens that we have in payment systems currently. So I think that work is very interesting, and what's being done in China could have a lot of relevance for other countries. A lot of other countries could learn quite a bit from this. Cheng Yun had 3 questions, so I'll just very briefly address those. First of all, how to subject institutions to regulatory requirements that are there for other institutions, particularly on reporting. I think that this is very important. There are some good practices that we see. So there are some central banks that are collecting information on fintech and big tech credit. So the People's Bank of China has some very good information on both fintech and big tech credit, and we've been in contact with Changchun about this. The Reserve Bank of New Zealand makes information on fintech credit available through its website, through a certain feature. Bank of Korea and the Bank of Finland also have tools like this. So there are cases where regulators are already collecting data and have a legal mandate to do so. And I think that this could be very promising, but very often this is only done when the sector reaches a certain size or when there's dedicated legislation that allows this. Regarding the differences between the effects of banking regulation and capital markets regulation, I think that Cheng Yu's intuition here may well be correct. I think that there are cases where FinTech and Big Tech credit providers are subject to capital markets regulation, but not necessarily to banking sector regulation. And how to safeguard financial stability? Well, that's a very important question. I think that ultimately, where there are risks from maturity transformation, those need to be addressed, just like in banking sector regulation. Where there are macroprudential risks or risks to financial stability, those should be addressed with macroprudential instruments that cover all forms of credit. But this is something that's still very early, and I think that a lot of regulators are thinking about these issues, and again can learn from one another. And regarding the supervisory model or the capacity to understand big tech, I agree here as well. I think that big tech is able to benefit from big data, from new forms of data, and from machine learning. But what's very interesting is that incumbent banks in some cases are also moving in this direction. So incumbent banks in some cases are also using big data and machine learning to price credit and to make credit models. In some cases, incumbent banks are also working with big techs and doing lending together. So, incumbent banks, of course, are already subject to banking regulation. And I think that it's a matter of making sure that the regulatory perimeter is adequate and that, regardless of whether it's big tech lending directly, big tech lending with a bank, or a bank lending, ideally the same activities should be subject to the same regulation. Paui had a very interesting perspective as well, particularly around financial inclusion in ASEAN, and just to underscore the point on amending credit bureau acts and including fintech and big tech lenders in credit bureaus. I think this is very important, and this is, I think, very analogous to what we were talking about just now with including fintech and big tech credit in regulatory reporting. So ideally, regulators should have information on fintech, big tech credit, but credit bureaus should also be making use of the data on all the different forms of lenders within a country. And I think that the work that Paui was mentioning is very important in that regard. Okay, I'll stop there, but thank you again for these great comments.
We are briefly talking about the big tech today and to explore the opportunity, but we also see people sometimes say big tech companies are quite harmful because of their strong discourse power on both commerce and politics. And because they have the huge data set and that might stifle the innovation from startups. So we would very much like to get your perspective. Do you see that we need a new paradigm for digital world? And also, how should we balance between that?
Okay. Well, sorry. I think, it's about the public goods and the regulatory and supervision. So that the two issues are very important. And I ever have a presentation on this issue. Is about the story of the light tower, the lighthouse, back to hundreds of years ago back in UK. Actually, the lighthouse could be classified as a public goods, but it seemed that almost all the lighthouses actually are provided. The services are provided by the private sector. So in that story, we can see that the public goods could be provided by the private sector, like nowadays the big tech services to the general public, including financial services and payment services. All those are public goods. All these are, some of them actually are financial infrastructure, but I think that kind of financial infrastructure services could be, although they are public goods, but still they can be provided by the private sector, on the condition that we have to have a strong regulatory or supervisory approach. So we have to guarantee there is no supervision arbitrage. And we have to guarantee that those service providers, those private sector, have to respect the ethics and the regulations from the authorities. So with the satisfaction of those requirements, personally, I think those financial services and financial infrastructure services could be provided by the big techs, because they can provide a better and more efficient services to the general public, but with the condition that they have to obey the regulation, they have to obey the ethics, and they have to respect the public ethics. I mean, they have to have some public, spirits, and to contribute, to make contributions to the whole society, not for the private interest, only for the private interest of their companies. So that's my view on this issue. Thank you.
Okay, thank you very much, Mr. Moon. So, Zhen Yun.
Yeah, I agree with what Chang Chen said, but I would like to add two points. I think there are possible, I wouldn't say solutions, but possible ways of thinking about this or dealing with the issues you present. And the first one would be, how can we enhance regulatory collaborations between different supervisory agencies or regulatory agencies? For example, how do we harmonize activities or endeavors from financial regulators as well as competition regulators and data privacy regulators? I think that would be the first key. And secondly, we tend to ignore the power of market discipline or the power of consumer empowerment. So I think we are living in a digital age. That means consumers should be able to have greater control over their data. And if that's the case, then consumers might be the last line of defense to defend their own data, to defend their own financial rights. So I think, how do we arouse the consumer awareness, and how do we empower consumers, in particular using technologies to empower consumers? I think that would be the second most important thing.
Thank you very much, Zhen Yun, on that. And Pao Yi?
Yeah, thank you for very interesting question. For me, I think I would supplement that in terms of maybe from the regulatory standpoint. I think also maybe if it's possible, we also, for example, in Thailand and other countries in Southeast Asia, maybe for SMEs or startups also still face the financial inclusion problem, right? So we also may need to put in place a proper regulation and support them as much as we can. But I think maybe in terms of the business model is also, yeah, I agree with you that maybe it's also very difficult for them to compete with the tech giant firms because due to the resources and many other factors. But it's also very difficult to say that which business model that they should follow. But I think maybe I'm thinking maybe also like how can I say you should think about how to coordinate or collaborate with them as well. I think it should be another way to do a business, but not like to compete each other. Yeah.
Okay. So finally, Jon.
Thanks a lot, Hong Yi. So regarding the convenience of big tech firms versus these worries about the potential harms and how to balance this, I think that this is right, and I think that economics shows us there are trade-offs. Very frequently, there are benefits that we want to achieve, but there are also risks and costs. And so there is a need for balance and for adequate quantification of those benefits and risks. Economics also shows us that services are often better when we have competition, when we have fair competition between multiple providers who should offer higher quality services and a lower price for doing so. But what's a bit difficult in the current environment with regard to big tech in particular is these powerful network effects. So big tech often provides, a social network or an e-commerce platform, things where it's very clear that the platform becomes more valuable the more people enter it. And this makes fair competition between platforms rather difficult, because one dominant player can capture a lot of market share, and it becomes very efficient for others to join that platform. And then that platform can, extract rents which may not even be monetary. They could be in the form of data. People are willing to trade their data for the convenient services, but those data are valuable, and they're not being compensated for it. So you and I, when we join a social network, we're contributing to the value of the network, but we're not paid to join the network. We're just given free services that we like. So there are issues that go far beyond finance. I think that there is a broad public debate about big tech at the moment. How do we ensure that we can have efficient competition between digital platforms? How do we ensure interoperability, data portability, so that people can port their data from one platform to another, and hence have a little bit of more of a competitive edge, and not be entirely dependent on one platform. But in the context of finance, I think it is very clear that we need to think about the public policy interventions that we have through regulations, through providing public infrastructures, and how we can make sure that those public policies contribute to fair competition between providers and adequately balancing these trade-offs that are there.
Okay, so Jon, Changchun, and Zhengyun, Paoyi, many thanks for your valuable time today, and also those following us online today. So before we close the session today, I also wanted to make an announcement of our upcoming webinar. So we have pleasure to invite Cass Baer, Research Fellow at the University of Cambridge, and he will speak for AI in financial service based on an empirical study on Friday, 17th July at 3 p.m. Beijing time. And also Daniel Leibao, the former executive director of HSBC Securities Singapore, will also join to present his speech on ethical use of AI in financial market. So I hope those topics might pique your interest as well. So once again, thank you, Jon, Changchun, and Zhengyun, as well as Paoyi, for all of your contribution to making today's webinar happen. So hope to see you in person in the near future, maybe in Basel, in Beijing, in Taipei, or in Bangkok. Thank you very much.
Thank you very much.
Have a nice day. Bye.
Thank you.
Good day.
Thank you. Yeah, have a good day.
Thanks. Bye.
Bye-bye.